Good evening, everyone. So thank you for joining in this webinar. My name is Wilson from Syfe Advisory Team, and I'll be the moderator for today's session. And today we'll be covering on Syfe investment philosophy and also the importance of asset allocation in a time of volatility. All right, so for today's webinar, we have Dhruv Arora, founder and CEO of Syfe. And joining in with him today will be Grace, Director of Investment Research at Syfe. Okay, so going through tonight's agenda, we'll be introducing Syfe and also touching on the current state of markets, plus sharing with you guys about active and passive investing. And after that, we'll be going deeper into the Syfe investment approach for our core portfolio before actually introducing the suite of product that Syfe has to offer. And last but not least, we'll be ending tonight's session with Q&A. So just feel free to actually drop your questions at the Q&A section. All right, over to you, Dhruv. Okay.
Awesome. All right, let's start with this poll.
Yeah, let me just put a question up. All right, so for today's first question for poll, we'll be actually checking with our viewers, how are they actually currently investing? Would they be investing with Syfe, or are they actually investing on their own, or some of them are staying at the sites, because of the market volatility? Okay, let's take a look at the answers. All right, quite a balanced mix of answer. So we have roughly around almost the same for people that's actually investing with Syfe and also investing on their own. So meaning to say that a lot of our clients are actually staying invested and they are actually eager to know how they can actually react to this market. So for question 2, we'll be actually checking in about what are the key concerns. So there will be stagflation, geopolitical tension, COVID-19 resurgence, and also interest rate hike. All right, let's take a look at the answers. Seems like a lot of viewers are concerned about stagflation, followed by interest rate hikes, and then geopolitical tension, and lastly with COVID resurgence. I see. So maybe we can actually touch on this later about the stagflation. Maybe Grace can actually share on this. Okay, moving on to the third question. So for the third question, we will be checking with viewers on their thoughts on inflation. Right, majority of our viewers are thinking that the inflation has not peaked yet, and there seems to be more around 29% that answers that it has peaked. So maybe we can actually drill down on this later as well.
Awesome. Thank you so much, Wilson, for the introduction, and thank you everyone for joining us today for this session about a brief introduction to Syfe, about a lot more about our investment philosophy, how our portfolios are built. And I'm sure a lot of you have questions about what should we be doing in these times, which both myself and Grace will be happy to answer on. As some of you might know, we are licensed by the MAS. More recently, in fact, literally a few days ago, we also achieved our license from the SFC in Hong Kong, which is going to be our second market. Having said that, Singapore is our headquarters. And more importantly, as a company, as a mission, right, we've always believed that we should make quality wealth management solutions accessible to everyone. So we've done that very well in Singapore over the last few years, and now we would like to take this to other parts of Asia. But that's just a quick summary of where we are today, and something that sets the base of the rest of today's presentation. Now, I think one thing very unique about Syfe is that we are, after all, an all-in-one platform. We started with what we call as Syfe Wealth. This is the managed portfolio solutions. This is smart, curated, personalized portfolios. We have our own set of in-house portfolios which we recommend users. But at the same time, we also allow customizations if you have a particular view that you want to address. At the same time, and more recently, earlier this year, we launched Syfe Trade. It's quite interesting. I think we are the first Singaporean company since iFast that actually got the license from MAS to launch a brokerage. And this is more for directed investing. It allows you to essentially buy that Amazon, that Tesla, etc., which you want. Very uniquely, the Syfe Trade platform allows you to actually buy in fractional sizes. So you could buy $10 of Amazon, $20 of Tesla, etc., as the case might be. We won't dwell much on that today because this is about our portfolios, but something that you should keep at the back of your mind. Now, we launched in July 2019, so coming close to 3 years on our platform. What has been very interesting in this span is that the wide variety of users that we've catered to, youngest users are about 18 years old. And in fact, well, we had a 16-year-old, which we had to turn away because it was below the acceptable age. But the oldest user which we have is 93 years old. Fun fact, the user is completely app driven. He, completely disagrees to use his laptop. So that's been very interesting. But the reason why we've had this diversity of users essentially is our existing users. And nearly half of our users now are referred through existing users, which tells us a lot about what we are building and how much our users appreciate the platform in some ways. Now, we've done many unique things. One thing that we are really well known for, and maybe we'll cover in one slide, is the Syfe Read Plus, which we launched in partnership with SGX. This is only unique to Syfe, and this tracks the iEdge index. At the same time, we also launched the custom ETF portfolio builder. Again, very unique. We are the only ones doing it. Just adding up a lot of options. Now, this thing has actually helped us become one of the top leading apps. On most days, you will find us in top 10 apps. Whether it's the on the iOS store example you can see out here. It's led to a bunch of awards. It's led to a lot of popularity on Dollars and Cents, which is again a platform that some of you might be more aware about. But at the same time, these things eventually led for us to continue getting sufficient investor interest globally. And we're very fortunate that we actually raised a very significant amount of money over the last few years, and more recently in July 21, which brings our total amount raised close to about 75 million Singapore dollars. Thereafter, in January this year is when we launched Syfe Trade, and as I mentioned earlier, just a few days ago, we've launched Syfe in Hong Kong as well. Now, the most important thing for us is always safety. And before we get on to our portfolios, I think it's very important that users should know how their money is handled. Now, when you transfer us money, whether it's coming on the wealth side or the trade side, all the cash assets are actually worked and kept with our banking partners, which are DBS and HSBC. Thereafter, once these assets are invested, they end up lying either with Citibank or with HSBC. So as you can see, we work with leading global partners, the most trustworthy names, and these assets are completely segregated to Syfe's own assets. So this is something that users obviously care about, because they say, what if something happens to Syfe? What happens to my assets? But because we work with a series of custodians, your assets are actually always segregated and always kept separate to our own assets. So this is something that is important to know, and something that gives a lot of our users comfort, and also the reason why the rapid growth that we've seen over the last few years. Now, there's no other way to put it. It's been a terrible start, to the year. I mean, it's been a terrible last 4 or 5 months. Every time we thought things were somewhere on the path of recovery, there have been shocks that we did not expect. I think a lot of people saw the hikes coming in some ways, but the way they've been happening has been a little bit off from the way how many analysts globally expected it to happen. At the same time, there's no denying that the war in Russia and Ukraine also is causing its impact, as you see, like that little dip that started in Feb on the early onset of the war, then leading up into the inflation kind of a setup. Now, this means that depending on the kind of index you're tracking, we are down, talking about anything between roughly about 22 to maybe even 27% in certain cases. And this phenomenon is to some extent expected, not ideal, expected. This was the same thing that caused the rally over the last few years. Now, what really was happening was we were in a very low interest rate environment. When we are in a low interest rate environment, investors, they always find tools that can give them a higher output or give them a higher return, which is where there's a lot of favoring for growth stocks, or very simply in our world, maybe many of the tech stocks, so as to speak. Now, when interest rates actually rise, there's obviously options for yield, but at the same time, many of these growth companies, for them, the access to capital also becomes tougher. And these factors playing in, along with the reopening that's now happening with COVID, the allocation of funds, plus the war, etc., has led to this correction in the markets that you have seen. So that is what we are seeing right now. And if you ask me, I would say that it's not something that we feel is done. we feel there could be more, short-term pain out here. Of course, we believe in investing for the long run, and something we'll talk about as we get along. But something that obviously we want our users and any investor to be cognizant of. And this is again a great example, right? ARC, which basically became the poster child of the whole, rally that happened during COVID. As you can see, this chart is across the last 2.5 years. It's basically come back to pretty much the levels it was in early 2020. Whereas, Berkshire Hathaway, which is obviously Warren Buffett's fund, which is more like, value driven, it still keeps on adding. It has also been impacted, as you can see, that little dip that's happened in the end. But if you see over long term, it has actually paid out. So if, of course, you have a very volatile asset, it can really help you in the short run in some ways, but you have to be prepared that you will have more, deviations and more significant, just the way you have the very strong upward moves, which we saw in 2020 and 2021, the same thing happens downwards. And again, this is not something we expect reversing very quickly, very soon. So in the long run, the picture could look different, but in the short run, we continue to expect to be in, a high interest rate or relatively high rate interest rate environment, which will make such kind of products or even the very, extreme kind of growth stocks less attractive. And this, I think, has been something that has probably surprised many of the people that we've spoken to. Now, when we were doing our research last year, and we knew, of course, inflation was something that, let's put it this way, many people were expecting, we made some very good decisions in a way that we, changed our cash plus product for a shorter duration. Hence, it's been giving positive return, whereas many of the cash products give negative return. But one thing that a lot of people expected would be a quality inflation. In fact, one of the thesis that was supporting cryptocurrencies was the fact that these can provide a hedge against inflation. So if you can see, especially late into last year, as a lot of people were expecting inflation to actually come in this year, and people were expecting rate hikes to happen, a lot of people started piling a significant amount of wealth into the likes of Bitcoin. But when markets actually collapse, when there is war and when these different kind of situations happen, that correlation to some extent actually breaks down. So if you think of it, that peak to trough that you are seeing in currencies like Bitcoin is actually even more significant than you have seen, whether in the SPY or in QQQ. So again, while, should cryptocurrencies be a part of the portfolios as a whole new discussion, I think it's interesting to highlight that something which was seen as potentially an inflation hedge is actually not panning out like one in these times. Of course, different factors at play. I'm sure many of you have read and followed about Terra USD, and that's something I'll be happy to talk a bit more about should that come out in Q&A. Okay, one more poll question. Let's go. This is the last one, guys, so let's do it well.
All right, so let's go for the fourth question over here. So after hearing the state of the market, just want to get a nice sensing on what actions the viewers have actually taken so far. Right, let's just take a look at the answer. Okay, you can see that most of our clients or viewers are actually doing dollar cost averaging. And a lot of are very optimistic of the market, and they're buying the dip in hopes of recovery. All right, let's move on.
All right. So I think one thing that has been coming up a lot of surfacing out now, is basically active and passive investing, right? So this might be a great chance to actually talk about what is active and passive and how are they different. And also this will lead up into the next section, which Grace would cover about more, a more detailed insight into our investment strategy. So an active or an alpha generating, strategy is a little bit more about which tries to outperform the index, outperform the benchmark, etc. Now, typically, because their premise is to outperform, they cost on the higher side. There's, of course, a much higher weightage that you have a quality manager. The investment horizon has to be shorter term. Otherwise, as you saw with the likes of ARK, ARKK, these things cannot work out the way you have. It's normally not that tax efficient. Reason being, you're buying and selling more frequently. So depending on the jurisdiction you are in, you probably will get subject to capital gains tax, as the case might be. And typically, unit trusts and mutual funds are the preferred choice when it comes to active investing. Now, the passive investing, the beta strategy, this is what more like Syfe adheres to. We are not here saying that, oh, we will basically, beat the markets and all. We will try to match the markets, maybe get slightly better than that. But we are not here on the premise that, we will constantly try to beat the markets. But at the same time, in that premise, we will be at a much lower cost. The risk on us as a manager or our strategies is significantly lower. There is no, humans out here who are saying A is better than B. It's completely systematic, completely, systems driven. We invest with a longer term horizon. Now, because we don't rebalance and churn our portfolios very often, it's actually much more efficient from a tax angle. And again, majority of our products, we do use ETFs. Now, as a platform, of course, we will use what is the right product. But when it comes to the core ones, I think ETFs for global exposure, ETFs by far become one of the best kind of tools that we can have, and the most cost-effective ones. Happy to talk a bit more about it, but that's our choice as we get along. Now, if you think about it, right, the reason why we say passive investing is the right way to think of it is that the reality is that a very small fraction of funds, if you look, and this is numbers are as of last year or 10-year horizon, only about 16 or 17% of funds actually have outperformed the S&P, right, in a span which lasts almost 10 years. So the question obviously is that why should you be giving, someone money, or why should you be giving an active manager money where they can't even beat the market, right? And this is the approach that has, some people probably knew about it, they just did not know how to do it or how to do it. And I guess solutions like Syfe, etc., did not exist. But I think this is important to know that, the funds which are a little bit more on the active side, they try to promise this constant outperformance, but you realize that it's easier said than done. And only a small percentage of funds do it on a regular basis. As you can see, over 10-year horizon, that number is just 17%. And this actually is something that is getting well tracked. As you can see, passively managed funds, the inflows that you are seeing are significantly higher over the years in active. I mean, if you go back maybe 10 years, this was somewhere almost similar in active passive, but over the last few years, this realization has come in. And as you can see, in fact, the last 7 or 8 years, they've always been actually net outflows from actively managed funds, which presumably are now getting into the passive funds as that number has continued increasing. Now, we mentioned about ETFs. Again, tax efficient is one side, but generally the way how ETFs are structured and the way how they are listed, almost always, in fact, I would say always, I'm yet to come across an example, if you're tracking a particular index or a particular setup, an ETF would always and always be cheaper than a mutual fund. And I think it's important to realize that this 10-20 basis points that you can save at the minimum, but in realistic, it's sometimes even 0.5% or 1%. This can actually really start, adding into your portfolio return, especially in markets like this, which are not very favorable. That extra 0.5% is something which you can save. Now, 0.5% in entirety might not sound a lot, but when you're investing over a 10-year horizon, it's significant. And that's one of the reasons why we also use ETFs. The other part, of course, is the kind of diversity that ETFs give you now across the world, not just, the US, but even the US-listed ETFs, they can give you access to, different markets and different products. I mean, I think it's quite public now. You even have ETFs to access Bitcoin, right? So they're a very powerful tool. And for that reason, of course, they've continued to get a lot of traction, invariably at the cost of, mutual funds and unit trusts. So if you are old school, you will use those, but the newer age investors, the savvier investors are actually, moving completely towards ETFs. And the reasons are here, right? I mean, if you look at the kind of fees that typically they charge, we mentioned about this, it's actually significantly lower for ETFs. The transparency is lower in these actively managed products as well. As you can see, they release the numbers on monthly basis. It's also in the top 10 holdings, etc. ETFs actually give you a complete visibility if you have the right tools as to every underlying holding on a daily basis, because it's a passive product, right? I mean, you have the constituents and the constituents will change on market prices. At the same time, the way how ETFs are structured, their turnover, which means what percentage of portfolio you are selling and buying off on an annual basis, is significantly lower. And tracking error, how closely they are tracking the benchmark, again, because they are passively by design, it's actually very, very closely tracking versus, active mutual funds who, by the virtue of desire to outperform, sometimes, do end up with a much higher tracking error. Wonderful. With that premise set, I'll maybe pass the baton to Grace to talk about our investment approach in core portfolios.
Hi, everyone. Yeah, so I'm here to just introduce our core portfolios. So Syfe core portfolios are designed for low cost, enhanced passive investing. Right, so we see that our core portfolios tend to be like the first or the starter portfolios for many of our investors. And they are, diversified across sectors and country. So going from like equity 100 to defensive, they hold a mix of 100% equities to a proportion of equities, bonds, and gold. We have heard from Drew earlier on the benefits of using ETFs. So next I'll go into sort of how do we pull it all together. So we start with first principles, right? So these are foundational propositions to our investment approach. So the first thing that we want to start with is diversification. This means not putting all your eggs in one basket. Right, so by investing a diversified portfolio, the risk of any particular sector causing a significant drawdown is reduced. Next, it's cost. This is very straightforward. We keep costs low so that you get to keep more of your return, right? This means that we select the most liquid and cost-efficient ETFs to use as building blocks. And core portfolios on Syfe, the average expense ratio is about 0.23 to 0.25%, depending on which portfolio you choose. And then lastly, long-term, we want to help investors build long-term wealth. And this means also investing for the long term and getting the most important decision right. All right, so then this comes to what drives long-term returns, right? So academic studies have shown that asset allocation is by far the most important driver of long-term returns and performance. So in fact, 94% of variability of returns comes from asset allocation versus market timing or security selection. The main driver of returns, what we call strategic asset allocation, which means how your long-term portfolio looks like, your portfolio weights for the long term, and that's derived from the mix and proportion of various asset classes that make up the portfolio. So at Syfe, we approach asset allocation systematically, and we've broken it up into a sort of a three-step process that would be iterative over time, right? So the first step, we do it through portfolio allocation. So we gain broad market exposure while distributing the overall risk budget of the portfolio. And next, we incorporate factors to add robustness to the core portfolios and capture smart beta. And then the next step is step 3, which sort of brings you back to step 1 and 2, except we do this every 6 months to optimize and keep the strategic asset allocation relatively stable, but addressing any price or factor drifts. So we'll go into more detail on each of the 3 steps in the next few slides. All right, so step 1. So traditionally, asset allocation is thought of in terms of capital, right? How much do you have to invest? So let's say you have 100,000 to invest, and then you allocate 60% of that, so that's about 60,000 to equities, and then the remaining to bond. So this way you get like a classic 60-40 portfolio. And then, for some people, they can rebalance periodically, so you maintain this allocation of 60-40. But at Syfe, we think that we want to do it through risk budgeting. So we call it asset class risk budgeting. It's a risk-based method of portfolio allocation where the overall risk of your portfolio is distributed among asset classes. So in this rather simple example, you have 5 ETFs in a portfolio. If you were to weigh them equally, right, then every ETF would be 20% of the portfolio. But doing like that, you don't really take risk into account. Right, so in this simple example, we show that if we use risk budgeting, right, so a riskier ETF, we have a smaller allocation to the portfolio. And in our approach, which it's a bit more involved, but so similar principles, is that we optimize the portfolio weights of each asset class to meet the overall risk budget of the portfolio. All right, so step 2, so as described in the previous slide, right, we want to gain exposure to the broad market while adjusting for risk. So we like to think of this as beta. This is like your traditional beta, and it's tends to be like market cap. You just want to capture market returns. But in addition, we think that there are factors, right? So we incorporate factors into our investing process as an enhancement. There are different ways of like grouping entities that share common characteristics. So factors have helped to explain they are the reasons and drivers of longer term returns. And this makes intuitive sense. So for example, like companies that are managed well tend to do better in the long term. And we've seen it play out quite recently too, in like 2020 and 2021, where there has been like a rotation to growth companies. So companies that are poised to grow, that have sort of shown a lot of potential growth in the future. People thought that they would do really well, and sort of placed more emphasis on them, but interest rates were low. So now that, again, we've seen sort of a rotation away from that, where value stocks are formed. So these are sort of ways to explain the drivers of total return. And our approach here is to combine like traditional beta with smart beta, right? So we are combining traditional beta with factors, and to do it in a systematic way. So we like to think of this as enhanced passive investing. Some of the factors that we consider are growth and value, minimum volatility, size, and lastly, country. All right, so this part, I just want to talk about the idea of an efficient frontier. So on the x-axis, you have what we think of risk or volatility, and it's measured by standard deviation. And then on the y-axis, it's your expected return. Right? So technically, you want to be sort of on the upper left-hand corner of this table. Like your portfolio should be as close to the frontier as possible, but you want, ultimately, you want to have high return at a low risk. And by first step, right? So which is you get the market portfolio. So that's you want to build a portfolio that's on the blue line. But further, as you incorporate factors, you try to push the frontier up, and you arrive at the golden line that's on top. And each dot, is a portfolio. So those that are closest to the frontier gives you the greatest returns for that level of risk. All right, and then step three. So step three, you do this every like twice a year in April and October. And the objective every time we do a rate optimization is to think, is this the long-term strategic portfolio that we want to build and hold while maximizing risk-adjusted return for each level, for each core portfolio, going from equity 100 to defensive. And the reason for optimization or re-optimization is that the risk contribution of the underlying assets change over time, and, because of price drifts and factor drifts. So re-optimization keeps that risk exposure stable while maximizing the risk-adjusted returns. And this helps investor to stay consistent and stick to the plan. And how it's done is that it sort of goes back to what we've explained in step 1 and 2. So we look at the overall portfolio we want to connect with the market, but also again to raise the efficient frontier up and have that enhanced passive investing solution. This also means that you won't really see a lot of portfolio changes over time. So the asset allocation has been pretty stable for the core portfolio. So this looks at equity allocation over time for the various portfolios. So we don't show bonds and gold, but that's also been relatively stable. And in the next slide, I'll go into the actual turnover. So every time we make this allocation or the optimization change, the underlying could change, right? So even though your equity allocation could stay at 80% or 100%, right? But the actual underlyings, like if we're allocating to a US equity portion or like international or China, for instance, that could still change as markets have moved. So we looked at in the last 2 rebalances, what has been that turnover at each time. And for both times, we've stayed led to be less than 10%. So in April, it's about 9%, 9.3, about average of 9%. And the reason for this is that, we know that going back to the slide about how 94% of long-term returns are explained by strategic asset allocation, right? So we want to keep that stable, and we don't want to have a lot of turnover that tends to firstly increase our transaction costs, but also tend to erode like long-term returns. Yeah, and now I hand it back to Drew to describe and go into our suite of products.
Thank you. Thanks for that, Grace. So essentially, when we've been building out our Syfe offering, and specific on the wealth side, we wanted to give users a gamut of offering that helps them address the kind of needs they have. In a way, what is the job that they're trying to achieve? So essentially, if you're looking for global exposure, that is where the core portfolios come into place. Something we strongly believe every individual should do, because of course, when you're living in Singapore, we have our salaries here, our homes here, our CPFs here. So you get the global exposure which is happening through the core portfolios. Now, if you're looking for something which is a bit more on the passive income side, a popular theme in Singapore, the REIT Plus is a great option, and also actually a very good inflation hedge in this environment, where you can actually get close to 5.5% dividend yields. What's the expectation for this year? At the same time, if you have a bit more specific kind of a desire where I want to either pursue ESG or disruptive tech or China growth, etc., then we have our thematic portfolios. I mentioned about this earlier, that we also have an option to customize not just this, but build your own portfolio with over 100 plus ETFs, best in class ETFs. It's quite interesting because we actually have a very stringent process where we pick and choose through multiple layers these ETFs, and then so essentially, if you're looking for an ETF to give exposure, let's say to Indonesia, the best ETF is something that's already chosen for you. So you can use that to basically create your own portfolios, and something that users really appreciate. And lastly, of course, in our offerings is the Cash Plus offering. And this is a very basic, as I mentioned, like a cash management offering. And this is something that users prefer if they just have spare cash, or if they're uncertain of markets, they just want to first park it up in Cash Plus and just let it get the 1.2% return. One thing I would like to highlight also in this Cash Plus offering is that it's actually been extremely stable and has continued to give positive and incremental returns, whereas some of the other products that are there in the market who actually promised higher returns. So actually, when everyone's have higher, we actually went lower because we knew inflation was coming, and this is something we did to ensure that we can give consistency in the returns. Whereas some of the other players who actually promised much higher, returns to their kind of smart offerings or cash smart, etc. offerings, those actually ended up giving significantly negative returns, which was not ideal. So that actually covers, the suite of options on the wealth side. And of course, just for completion, we obviously have the trade platform, which is something that we've covered briefly earlier. Now, the question that we get often asked is that, okay, you have all these portfolios. How do I actually, end up building my portfolio? So, and this is a topic that we specifically talk about, which is what we call the core satellite investment strategy. The premise out here is that for us, and as I mentioned, the core of your portfolio typically should be one of the core portfolios, which, depending on your risk appetite, could be a defensive, balanced growth or equity 100. Now, what changes between these portfolios is the allocation to equity, which is the riskier asset class. So a defensive portfolio will maybe have 15-20% allocation to equity. An equity 100, as the name suggests, will have 100% allocation to equity. So depending where you are in life, what is your risk appetite, what's your kind of, aspiration level of what you want to come out, you decide your core product. And somewhere that should form a significant chunk of your investment. Thereafter, you can actually add all the different layers whether it's, options like REIT Plus, whether it's one of the custom portfolios or thematics, or of course, if you want to actually, trade as well. Now, we've always, said that in the last few years, everyone thought that, they are like star traders, etc. The reality is that when markets are good, everyone will make money. And some people who are better will make more and some will make less. But for consistent long-term wealth accumulation, there needs to be a more systematic passive investment strategy. And that's what we are proposing, right? So we're not saying that don't do any of these desired calls, or if you want to buy, I guess, a Bitcoin or, a Tesla or Amazon, etc., as the case might be. But let that be a part of your, investment thesis. Of course, if you are a full-time finance expert who does this for a living, please, by all means, go ahead and do it. But majority of us who are, on platforms like us, myself included, we either don't have the time or we don't have the expertise to actually sit and, constantly look and constantly build our portfolio on our own. So an option like Syfe Core becomes the basis and what we think should be your kind of core portfolio. And then you add it on to layers depending on you. Now, the percentage splits, what should you choose, etc., is something which, as I said, is very dependent on the person, on the individual. And this is something that we can help you with. but also there is a lot of research as well as tools available on our website. Now, before we just get on to the people who can help you, Wilson being one of them, I think it's really important that who actually forms your investment team, how are these ETFs chosen, how are these portfolios constructed. As you can see, we actually have a very, very robust investment team, which now actually has more than 10 individuals. And as you can see out here, the expertise that is, with the team out here has been very, very strong. We have individuals who've worked at the best banks, the biggest hedge funds, our professors, our quants, our PhDs. All of them come together, to build these options for you. So I wouldn't go and spend time one after the other, but something that you should be comfortable of is that this is not something which is done by amateurs or done by a team of 1 or 2 people. It's actually quite a robust team that constantly is working on researching and essentially improving the product and the offering that we have for our users. And now coming to the "we are here to help" section, in fact. So when I spoke about the core and the satellite portfolios, I can understand this might be a bit overwhelming, especially in today's date, or also what should be the allocation or what's the right core portfolio. So one thing that a lot of our users do prefer is to speak to our advisors. Now, rest assured, these are not your salesy kind of people. There are no incentives given to Wilson if he gets more or less clients, etc. We generally want to help people to understand our offerings and see if these offerings are right for you. Because the way how we've always thought about it is that, as we've said with our portfolios, this is a long-term initiative. This is not a short-term thing. In fact, in the short run, it's actually, we don't even make anything out of it, because our fees only starts kicking in, after you've been there for a significant amount of time. But keeping that in mind, if you do need assistance and a little bit of human touch outside the tools and services that we have on our website, feel free to reach out to one of our wealth experts. They're all MAS licensed, and they can help you understand both the offerings and see how they align better with your choices, your phase in life, and more importantly, your goals. When it comes to the different kind of tiers in pricing and what does it really cost, so the Cash Plus offering is completely free. We think this is more like a tool for people to dip their toes into the investment world, so as to speak. But on the actual investment portfolios, the core, the REIT plus thematics, the fees actually decreases as you keep on increasing your portfolio size, whether it is because of positive mark-to-market movements or whether it's because of invested capital. So the tiers are Blue, Black, Gold, and Private Wealth. And essentially the fees, decreases from 65 basis points all the way to 35 basis points for individuals investing over $500,000. If you are on our Gold tier, which starts at $100,000 and above, you will actually even get access to a dedicated team or a dedicated advisor, as the case might be. So again, it doesn't cost a lot to get started, but this fees is all inclusive. There is no brokerage, there is nothing extra on it. There's no GST or anything of that sort. It's all absorbed into one. So there's no trading fees, there's no entry exit charges, there is no minimum balance. You can withdraw anytime. There's no cap on withdrawals. Unlimited rebalancing. You can move between portfolios as much as you like. And again, with everything that we do, we continue choosing very low cost ETFs, because if we choose low cost, it actually ends up eventually adding up in your performance and in the output that you get. Okay, Grace, this is a section that you shine in, so I'll pass it back to you.
Thanks, Drew. Yeah, so I mean, this is a question that we get a lot, and also I think even as we are in the industry, and I've done this even for my own investment. I think it's I was quite surprised when I actually saw the numbers. So in this chart, we try to show, to illustrate, right, in terms of dollars, for someone who's tried to who has the best luck, right, who tried to time the markets and managed to do it at the best time every year, like consistently, since 2004. Right, so Hing Henry, he invests $10,000 at the lowest point every year. So it means like he gets the maximum, sort of return in that time period, right? He doesn't have any, I guess he's not as unlucky as Susan, who's like the opposite, right? Who sort of invests at the peak every time. Because Susan gets the question like, it's not a time to invest. Should I wait? Is it gonna change? And I think what was quite surprising, or like in terms of dollars, that it worked out for Stacy, for someone who's very steady, who DCAs, dollar cost average, splitting that same amount of money, but so investing, $10,000 divided by 12, so doing it constantly every single month, ends up pretty close, right? Like really close to Henry, but also something that people may not expect is that Susan, who's the opposite, right, who's very sway, goes in at the highest time every year. So still does pretty okay, right? She's definitely lower than Henry. But for someone who, for Kit, right, who kept the savings in just like a bank account, and that's I think 0.07 or 0.1% every year, like a typical deposit account. And that leaves him with much lower than the other three. So I think the main takeaway here is that slow and steady wins the race. It's impossible to be like Henry, but of course we can all try to be more like Stacy. And I think if I could sort of add one more to this, is that we want to, in terms of volatility, there are many things that we cannot control, but I think there are three main things that we can control, right? Firstly, our own actions, like, if we do decide to either invest more or to leave the market, or if we need that money for something, to decide when is the time to come back. So like in that sense, we have to be quite thoughtful about our own actions. That's something we can control, but also on cost, like what we talked about before, right? On cost, you can definitely choose a lower cost option, right? That would enhance your long-term returns. And then the third point is on diversification. Like these are things that as investors, regardless of how the market is doing, that we can take on our actions that we can take on our own. Yeah, and then now we'll pass it back to Wilson to see if we have any posted questions.
Sure. All right, so we do have actually one question by our viewers. So he's actually asking for the performance of our portfolios against QQQ this index in this itself. So maybe you guys want to share about like how we benchmark our portfolio too.
Yeah, sure. So I think it's interesting. I mean, see, any performance, you have to look at it at a time horizon, right? So I'm not sure what time horizon you're looking at. I think if you look at in the last maybe 10 years, of course, QQQ has done significantly well and it's performed extremely well. But I have the numbers about the performance still actually year-to-date performance between January 1st and April 30th. QQQ actually was at minus 21%. Of course, which has actually now become minus 27, as you can see, whereas equity 100 was at minus 12.7%. So again, this talks about the things, about this diversification that comes through this portfolio construction methodology. And the question why people sometimes ask, why should I come to Syfe and, not really invest myself in QQ? These are some of those reasons, yeah. So year to date, or at least till April 30th, when I have the numbers, the outperformance was about 9%. I think that number only would have increased now because QQQ has come off a lot in the last few days with the moves.
All right, thank you, Dhruv. So maybe one more question. So earlier on, you talked about active and passive investing, and in that case, right, should investors be actually looking to allocate maybe a small percentage into active strategies, or how should they look at it? Yeah, it's a great question, Wilson. So I think if you can just go back to that that satellite core chart that we had, right, in some ways that we had just shown a few slides before. The thing is, the next one, So here, essentially, this is exactly what I think the user is trying to ask, right? Somewhere, our view is that your core strategy should be around the Syfe core, should be still where the kind of so-called passive investment is happening, so as to speak. And if you're taking a part of it for active because you have a view, you have a desire, or you have got some extra money from some pot and you want to do it, it's completely fine. I think the problem happens when
people start making some money on these active strategies in the short run, and then they go aggressive. And then when the significant corrections happen, they actually end up in a very, very bad place. And we've seen that, right? We've seen it, people who are doing this, and a slight digression, but I know people who've put significant amount of money in some of these Terra and Luna cryptos, and realize, oh, it's great, I'm getting 20% yield, it's a no-brainer, so on and so forth. But there was obviously a catch, right? And when those things start happening, they end up wiping out a significant part of their investment. So I would say that if you're allocating it to active, be prepared that the variation that can happen in this piece can be much more than your passive piece. And that is something that, you should, be cognizant of here.
Right. Thank you, Dhruv. All right. So maybe we can actually also touch on in terms of our portfolios, right? Like for example, in core portfolios, would there be any dividends, or do you think that REITs portfolio should be the passive income approach for all investors?
Yeah. No, it's actually a very good question. We should talk a bit more about it. One of the big advantages of investing with Syfe is that we automatically reinvest your dividends. And that is great, because just take an example. For example, if over a long run, if you look at the REIT product, it roughly gives a 10% return in a year. And if you get 5% dividend, investing that extra 5% increases your portfolio performance by 0.5%, because you're going to get 10% on that 5% as well. So as soon as you get the dividend, that dividend goes in your portfolio as cash, and then that cash actually gets reinvested. Because the premise we have is that these dividends are typically small there, but they additively become very significant. So it keeps on going in your portfolio. You see it, you will see lines which say dividend. But if you ever want to withdraw, like always, you can withdraw a fraction of the portfolio also. You don't need to withdraw the full portfolio, right? So you do get 100% pass through of the dividends, and they get automatically reinvested. And it's up to you if you want to pull them out. In fact, in the REIT product, for customers over the black tier, you can even choose to get auto payout on a quarterly basis, right? So these options already exist, and something that you can explore more on the website. Yeah.
Right. Thank you, Dhruv. So one question by our viewer talking about interest rate hikes.
Yeah.
So
yeah, I think the user means some more hikes are expected than rate cuts, right?
Yeah.
Yeah, I think it's a great question, right? So should you go into the market now? Much more negative. The question I would always ask you is, what is your time horizon? If your time horizon is 3 months, 6 months, then I would say probably don't, right? Because it is possible that, in these situations, things will happen which might not be favorable. But if you have a longer term horizon, then it might be worthwhile to start dipping in your toes right now. I personally probably wouldn't recommend going all in, but start dipping in your toes, because when things change, there could be factors which we don't see. Russia and Ukraine tomorrow reach a conclusion, markets will rally on that fact, right? They might not rally up to recover everything they've lost, but they can rally to cover a significant part of the losses, right? So I think the way how I would always think of it is that check what your time horizon is. And if your time horizon is long enough, these environments, though might not be perfect, I still think completely staying away might not be the best, because again, if something happens and things right, then you're like, oh shit, I missed the bottom, missed the top, right? So start putting in small clips, and I think that should basically see you through.
Awesome. All right. Thank you, Dhruv.
And I think I think there was one more question which user says that, like, how is okay, they've actually come back to it. Okay, that's good. All well, thank you.
Okay. All right.
So awesome.
Maybe, for Grace, anything that you want to add on?
Yeah, no, I mean, thanks everyone for staying till the end. I do have a webinar promo code to share. So please enjoy, if you're a new client, we get to enjoy a 3-month fee waiver for investments up to $30,000, and it's valid until the end of the year.
All right, so for our viewers that are new to Syfe, so you can actually reach out to the advisors to actually schedule a call with them and then inquire more about the portfolios, so to understand, like, in terms of which life stages you are in and how we can actually assist you in terms of selecting the portfolios. And we do have regular webinars on every Thursday. So just feel free to join us in. They will be touching on different topics and also more in depth about the market situation and stuff. So if you guys are interested, you can actually join us there. If not, that'll be
Sorry,
all.
can I just add one thing? So next week our webinar is on Tuesday, and we're hosting a session with Dawn of SG Budget Babe, and we'll be talking about this how do you invest during times of market volatility. What are some ideas, like how does she invest in these times? So yeah, please join us next Tuesday, 7 to 8 p.m.
All right, Chi, we do have one last question for our viewer. So he's asking whether can we readjust or change the fund for our customized portfolio? Grace, you want to take this?
Yeah, sure. I mean, so if you already have a custom portfolio, or if you want to make one, then you can go onto the custom tab on your app or desktop, and there are I think now we have 130 ETFs that you can choose from. And then so if you put it together, instantly you get to see like the historical returns, the sector allocations, and so on. Not sure if that answers the question. And then you can sort of say buy it and adjust the weights, and create your own portfolio.
Okay, maybe I just add on to what Grace have mentioned, right? For our customized portfolio, once you guys actually pop onto our customized screen, what happens is after selecting the different ETF to form a portfolio, you guys will be able to actually adjust the allocation in the sense that, for example, you have 5 different ETFs, you can choose different allocation and weightage to them. And what we actually offer is to show you the portfolio or overview of what is the different sectors or even country exposure that you'll be getting through this selection of different ETFs. And for our portfolios, the fees will be charges the same as our managed portfolio. So you'll be based on the different tiers that you guys are in.
Yeah, I was wondering if the question was that can you readjust or change after the portfolio has been set, right? So that's something that actually we are working on. But another way that you could do is actually set up a new portfolio and sell off this portfolio and just transfer the funds, right? Because we don't charge any brokerage charges or anything. I think the cost for you is going to be negligible. But we are working on something that will allow you to even edit the portfolios once they have been set up, if that was your question, right? So hope that between these answers, you've got your answer. No, wonderful. Thank you everyone for joining us tonight. And please go out and enjoy. Singapore's open now. So let's have a good evening, everyone. Thank you so much for joining us.
Thank you, everyone. Have a good evening.